SCHD just dropped 10% in the last 2 weeks, with about $560,000 invested. That means my portfolio is down roughly $56,000 on paper. So the big question is, do you sell, buy more, or simply hold through it? In this video, I'm breaking down exactly what I'm doing and why. I'll explain the real reasons behind SCHD's recent decline, whether this type of pullback is normal, and how SCHD has historically recovered from similar corrections in the past. I'll also walk through the 3 rules I personally follow during market downturns to avoid emotional investing mistakes and stay focused on long-term income growth. By the end, you'll have a clearer framework for handling your own SCHD position during volatility, and whether this drop looks more like a buying opportunity or a warning sign. Quick disclaimer: this is my personal investing approach, not financial advice. I'm not a licensed financial advisor, and your goals, timeline, and risk tolerance may be very different from mine. Let me explain what happened with SCHD. Over the last 2 weeks, SCHD dropped from around $95 per share to roughly $85.50, a decline of about 10%. The broader market also pulled back, with the S&P 500 down around 8% and the Dow falling close to 9%. SCHD declined a bit more because of its larger exposure to financial and energy stocks, which were hit harder during the sell-off. The main driver behind the drop was the Federal Reserve signaling that interest rates could stay higher for longer. That created pressure on banks and energy companies like JP Morgan, Chevron, and ExxonMobil, which are major holdings inside SCHD. Is this unusual? Not really. SCHD has gone through corrections before. It dropped around 18% in 2022 and more than 30% during the 2020 market crash. A 10% pullback is generally considered a normal correction for stock ETFs. Personally, with about 6,550 shares, my portfolio value fell significantly on paper. But because I haven't sold any shares, those losses are still unrealized. Volatility is simply part of long-term investing, especially with dividend-focused funds like SCHD. Here's my decision. I'm buying more SCHD. At around $85.50 per share, SCHD now yields roughly 4.2%, compared to about 3.8% when it was trading near $95. The dividend itself hasn't changed. The share price has. That means every new share I buy today generates more income than it did a few weeks ago. I'm personally adding another $25,000, which buys roughly 292 additional shares at current prices. Instead of trying to perfectly call the bottom, I'm slowly averaging into the decline over time. If SCHD falls further, I'll keep buying in stages rather than putting all my cash in at once. Why not wait for the exact bottom? Because nobody consistently predicts it. The market could drop more, or SCHD could rebound quickly. Dollar-cost averaging removes the stress of trying to time every move perfectly. I'm also not selling because my focus is long-term dividend income, not short-term price fluctuations. SCHD's income stream remains strong, and the companies inside the fund still have solid fundamentals. To me, lower prices on quality assets create opportunity. Higher yields today can mean much larger income streams years from now. Let's look at how SCHD has historically recovered after major market declines. 2020 COVID crash, SCHD dropped about 33%, falling from roughly $62 to around $41.50. Despite the sharp decline, it fully recovered in about 5 months. Investors who bought near the lows saw gains close to 50% during the rebound. 2022 bear market, SCHD declined around 18%, dropping from about $79 to near $64.70. Recovery took roughly 14 months, but investors continued collecting dividends during that period. Those who kept buying during the decline were rewarded over time. 2018 correction, SCHD, fell about 12%, moving from roughly $56 to $49.30. The recovery happened within 4 months. The bigger picture, SCHD, has recovered from every major correction so far. Some rebounds happened quickly, while others took over a year. But the long-term trend stayed positive because the fund owns financially strong dividend-paying companies. Could it fall more from here? Absolutely. Past declines have reached anywhere from 18% to over 30%. That's why many long-term investors focus less on predicting the exact bottom and more on gradually buying during corrections while yields are higher and future income potential improves. Here are the 3 rules I follow during SCHD market corrections. Rule 1: never panic sell. A market drop only becomes a real loss when you sell. I don't sell just because the price falls. I would only consider exiting if SCHD's fundamentals changed significantly, like a major dividend cut or a shift in the ETF strategy. Short-term volatility alone isn't enough reason for me to leave. Rule 2: buy gradually, not all at once. Instead of investing every dollar at one price, I spread purchases out over time. I might buy some shares today, then add more later if prices continue falling. This lowers the pressure of trying to perfectly predict the bottom and helps improve my average cost over time. Rule 3: focus on dividend income, not daily prices. Prices move up and down constantly, but my main focus is the income stream. As long as SCHD keeps paying and growing dividends, temporary price swings don't change the long-term strategy. In fact, lower prices can actually improve future income by allowing me to buy more shares at higher yields. These rules help me stay calm, disciplined, and focused during market volatility. Here's what I'd consider depending on your situation. If you already own SCHD, try not to panic sell during a correction. If you have extra cash available, this may be an opportunity to add more shares at lower prices. The dividend hasn't changed, only the price has, so your yield is actually improving. If you don't own SCHD yet, this pullback could be a solid entry point. Lower prices mean higher future income potential. Instead of investing all at once, consider starting small and building your position gradually over time. If you're retired and living off dividends, focus on the income stream rather than short-term price swings. Daily market volatility doesn't automatically reduce the dividends you receive, which is what matters most for cash flow. If you're younger and still building wealth, corrections can be valuable opportunities to accumulate more shares at discounted prices. Over decades, compounding and dividend growth can make a huge difference. What not to do? Don't panic. Constantly watch daily price movements or try to perfectly time the bottom. Stay consistent. Focus on quality investments. Reinvest when possible. And keep your attention on the long-term plan instead of short-term fear. Here's the bottom line. SCHD dropped 10%, and I'm buying more. I'm adding another $25,000 at around $85.50 per share because the dividend stayed the same while the price became cheaper. That means every new share I buy now produces more income than it did a few weeks ago. Historically, SCHD has recovered from every major correction. Sometimes the rebound happens quickly, sometimes it takes longer, but the long-term trend has remained strong. The companies inside the ETF are still profitable, the dividend continues growing, and the overall fundamentals haven't changed. I'm not panic selling because my focus is long-term dividend income, not short-term price swings. Market volatility is normal, especially with dividend-focused stock ETFs. For me, lower prices on quality assets create opportunity. Higher yields today can mean much larger income streams years from now. Now I want to hear from you. Are you buying more SCHD, holding your position, or selling during this drop? Share your strategy and reasoning in the comments. Subscribe for more real-time portfolio updates, dividend investing strategies, and market correction analysis.